Hello everyone, hope you're all doing great. Today's video I want to share with you really about what Jay Powell talked about and why the market rallied. I think as we are in 2019, the Federal Reserve will be the most important thing that we should keep our eyes out on. So with that being said, let's jump straight into the video on why the market rallied. As you can see here today, the S&P 500, in addition with your Dow Jones and NASDAQ, they all performed really strong. They held positive 3% throughout the whole day, mainly because of the strong jobs report numbers that we got today. But more specifically, I think what Jay Powell said really reassured everyone. So the meeting that Powell attended was the American Economic Association meeting. It was held today in Atlanta, Georgia. And here on the website, you can see there are multiple events happening today. A lot of these are just economic events, but the most important one that everyone cared really about was the one that Jay Powell was at. It was about a 2-hour meeting, or kind of like a panel discussion. And I actually want to share with you what Powell said. So in this clip that I found, it's about 20 seconds long, but I think it's really worth your time to kind of listen to exactly what he's saying word for word. So take a listen.
First, as always, there is no preset path for policy. And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly.
So in that video, Powell's just saying how he will be very patient, especially when it comes to rate hikes and also quantitative tightening. I think more specifically, he's saying how if there's anything regarding with their policy, QT, and also rate hikes, the Federal Reserve, they're flexible and they're willing to support the economy if that is the right thing to do. You know, he's saying how in order to keep the economy on track, there's really no preset path for policy, and they're going to be very cautious of how they do it. And I think really that's the reason why the market rallied today. The market just wanted to see Powell reassuring everyone that he is willing to be flexible. However, I found this very interesting paragraph of where Powell himself is saying on, this was like the most recent FOMC meeting, or his press conference on December 19th, 2018. This is a transcript where Powell is essentially saying the exact same thing as he is today in regards to flexibility. He's saying that he wants to emphasize that their policy decisions are not on a preset course, and it will change materially depending on the outlook. And he's saying that he will reevaluate depending on the global economic and financial developments. You know, so the market, again, like I think the market did not rally last time during this release, because Powell at the time was saying how the Federal Reserve's balance sheet will be on autopilot. And I think that word autopilot scared everyone, despite him saying that they are not on a preset course. More specifically, when he was actually asked about the balance sheet reduction, he's saying here again that he doesn't think that the recent stock market turbulence has anything to do with the balance sheet reduction. However, he's saying if it was the normalization plan, if it was in fact an issue, then he won't hesitate to make any change to the balance sheet reduction. You know, currently what's happening right now is that the Federal Reserve, they're allowing $50 billion of bonds mature every single month, and they're no longer reinvesting that principal. So that's pulling liquidity out of the economy. This is the balance sheet that I'm talking about, where it's currently sitting at $4 trillion. The Federal Reserve's plan is for the next 4 to 6 years is to actually reduce this amount to a more normal level, which would be about $2.5 to $3 trillion. But my personal opinion is that they probably won't even get there. And here's a pretty cool graph I found where the 6-month Treasury yield is actually inverted with your 10-year Treasury yield. Now, believe it or not, right, the 6-month Treasury yield is 10 basis points higher than your 5-year Treasury yield. And, the reason for this is probably because the market just simply does not believe the Federal Reserve with their rate hike expectation. What this is signaling to the market is really two things. Number one is that growth expectation for 2019 and beyond should drag. That's why people are locking in the higher or the longer duration, like the 5-year, 10-year, 30-year bonds now. And the second thing is, when it comes to the 6-month Treasury yield being this high, more than your longer-term bonds, what that is telling me is that the bond market participant believes that the Fed will cut rates in 2019, which would then lower your 3-month, your 6-month, your 1-year Treasuries. That's exactly how I'm reading it. The market just does not believe the Fed will continue hiking, and that a rate hike is probably on the way due to weaker than expected economic data. So really, this was a pretty quick video, but I just wanted to put this on everyone's radar, keep them alert on what Powell is saying and why that moved the market today. I think longer term, it's the right thing for the Federal Reserve to continue hiking and to continue their quantitative tightening. But for now, the market is getting some relief because they feel much better of Powell's reassurance on the flexibility in rate hikes and also quantitative tightening. So thank you everyone again for watching the video. If you liked it, please give me a thumbs up. If you thought it was helpful, feel free to subscribe. Drop a comment below as well if you want to hear my thoughts. So happy Friday, everyone. Hope you all have a great weekend. And thank you again for watching the video. See you, everyone. Bye.